My name is John Icharia. I'm the program lead at the Jasiri Growth Accelerator. Jasiri is one of the entities under Allan Gill Gray Philanthropies. And I'm going to start by walking us through just a brief background about what we do. But before I get into all of that, I love to also learn a bit more about who's in the room, and particularly on the founder side. So if you are a founder, please raise your hand. If you're a founder, please raise your hand. If you're an investor, please raise your hand. All right, founder, investor, I like that. If you work at a startup or partner with startups, please raise your hand. Okay, I think we have a general understanding. That's good. All right, so this session, as curated, was to understand what accelerators do for startups, and particularly the Jasiri model. So we're all aware that accelerators play a pivotal role in startup growth, startup support, and we wanted to shed a bit more light about what we as Jasiri do and what we do differently and why we do it differently. Now, I just want to give a brief background about our organization. Our organization is called Allan Gill Gray Philanthropies, and it is a philanthropic element of Allan Gray. Allan Gray is a South African financial services company that was started by Dr. Allan Gray in 1973 and has been operating since. It has a Pan-African presence and also has grown globally. They created a separate company to go on the global front called Orbis Investments, and they focus mainly on providing financial services and investment opportunities for stakeholders such as yourselves. Now, allow me to read on my laptop here, just as the screen is quite small to see. But the Allan Gill Gray Philanthropies Foundation was set up in 2015 by Dr. Gray and his wife. It was particularly built to support entrepreneurs across the continent bridge critical gaps that they're going through and be able to develop high impact and responsible entrepreneurship across the continent. The main objective is to reduce unemployment and attack poverty through job creation. There is a famous quote or prose I want to read by Dr. Gray, and he says, "Businesses can and must be a force for good by their offering to their clients and customers value for money, creating good employment opportunities, raising innovation and efficiency, therefore earning a profit while contributing to the welfare of others. Profit in turn generates revenue for the government to render public services by way of taxes. Growth for businesses, the ability to serve more customers and create future employment, and reward the entrepreneurs for their efforts along the way. A portion of which may be deployed through philanthropy and be invested in communities by financing social entrepreneurs, creating a win-win situation for all. Such businesses and such entrepreneurs view philanthropy simply as a natural extension to their purpose in their business contribution to society." Now, what Dr. Gray was basically, sorry, I do have a bit of a cold, trying to bring across is that businesses do not operate in isolation. The reason we create businesses, be it for-profit or non-profit, is to be able to create impact as we, as the stakeholders or shareholders in those businesses, also generate value for ourselves. The vision and mission of our organization is, the vision is an empowered, prosperous, productively engaged African citizenry, thriving in ethical societies with dignity and hope. And our mission specifically is we attack poverty by investing and nurturing, empowering responsible entrepreneurs and leaders who benefit society by accelerating meaningful employment creation while embodying values and behaviors of ethical leadership. Now, across the philanthropy, we have a lot of entities, and I just want to quickly highlight before I get into the topic of the day. And we as Jasiri are one entity, and what this visual is basically looking at is the different areas we operate in across with our different offerings. The first is a high school intervention where we look to identify talent for future entrepreneurs, and we do have support programs across Southern Africa and Eastern Africa identifying and developing this talent. Us as Jasiri within the East African region are tasked with launching and investing in ventures. Our big ambitious goal is to launch and support 2,000 ventures across Eastern Africa by 2030, which is coming up quite fast. Then we have our sister entities that support with building ventures on the Southern African side, as well as growing and investing them again on the Southern African side. Now, specifically looking at what Jasiri does and why we're here. Jasiri is an accelerator, and what the accelerator focuses on is we provide holistic pre-seed investment and non-financial support to early stage, high potential startups, typically that are regarded as too risky for commercial investment, equipping them with tailored funding, advisory support towards their growth objectives and building funding readiness. I'm sure all the investors in the room have come across different venture opportunities that have different levels of funding readiness and the ability to absorb the capital that could be deployed to them. There are, of course, challenges, and what we do is build the bridge to de-risk those challenges that startups do face. Now, the pre-seed investment goes towards funding operating capital, as well as CapEx investments into the businesses. We are a sector-agnostic program. We focus on building for high growth, ventures that have demonstrated product market fit and real scale potential. And we have a particular lens that we hold true to our hearts. We call it market creating innovations. And these are innovations that basically focus on building products, solutions, looking at underserved demand within different markets. And the idea is once you unlock this demand, you are able to then build for sustainability. We have examples that I will speak to. Apologies. But getting into the nutshell of our program, it is a 12-month program that I've mentioned combines catalytic support in strategic priority areas, referencing working capital and other areas of finance that are required within the venture. Now, it is three-pronged. Typically, within our accelerator, the first is we build a partnership. So we don't just support businesses because there is an opportunity to support the business, but what we do is build a long-term partnership, and I will speak to why that comes about. And we do this because we recognize the realities of building high-impact ventures in Africa is not a short-term journey. The JGA collaborates with ecosystem partners to be able to help founders strengthen their business models, scale effectively, creating long-lasting impact for their communities. I just want to reference back to Allan Gray. Allan Gray started its business in 1973 and has been operating for the last 50+ years. And one of the key value propositions it has to its customers is long-term commitment and long-term investing. True wealth creation and true value is actually achieved by doing something for the long run. So what we do is embody those values within our organization to be able to support ventures within the accelerator that go through. Now, directly within the accelerator, we have tailored venture support, where each venture actually receives hands-on support based on the needs within the particular venture. We do understand from a sector-agnostic base that each company is unique and the challenges it's trying to solve are equally as unique. Therefore, the support it requires is not a one-size-fits-all. It looks at it from a position that how do we understand what is the venture trying to do, what are the founders trying to build, who is the key customer in this particular venture, and beyond that, what type of market or environment are they operating in. From this assessment, we're able to tailor some support that is prioritizing key milestones that unlock growth and potentially even unlock follow-on opportunities such as capital. The program is 12 months. However, we do have multiple cycles for opportunities where founders can come through. And ultimately, like any investor knows, accelerators typically position ventures to be funding ready, basically allowing them to be able to absorb the capital that they require to unlock scale. Now, what that means practically in an accelerator such as Jasiri is we focus on building a sustainable business, so addressing key gaps that could be within the business. Our first objective before we go to the market, the capital markets, is to make sure that the business is bankable. And I repeat that because if a business isn't bankable, nobody is going to come and trust that you will suddenly convert it into something that is sustainable and commercially scalable. So bankability is a core thing that we try to build over the 12-month period, understanding that these businesses have established early product market fit, and from that we're able to look at how is it we can ensure that the business continues to maintain, sorry, I do have a bit of a cold, apologies. The business is able to maintain its trajectory for growth sustainably with or without potential for loan capital. Now, who do we support? We have an internal pipeline called the Jasiri Talent Investor, which is another opportunity for individuals who are looking to kick off their entrepreneurship journey. That is an incubator program. So we do have ventures that are created out of the incubator program that could transition to the accelerator. And then secondly to this, we have external startups that have the opportunity to join in, startups particularly operating within Kenya and Rwanda. The process for selection is multi-staged. It typically takes about 3 to 4 months from application through to investment committee decisions. And should you go through along each stage of the way, you do also, not only do you get feedback, but you actually get important insights into what you could consider for building your business to position it much better. Now, our investment thesis as Jasiri is grounded, as I mentioned, in market-creating innovations that unlock demand. We try and prioritize de-risking of early-stage startups. We provide hands-on venture building and strategic capital through tailored support. Now, within the accelerator, the ventures do receive capital, and this capital is through a $75,000 safe instrument. And I will speak to why we particularly positioned it this way, as I do some comparisons much later on. However, we do feel like this is an opportunity for ventures to tap into capital, but through the safe instrument also allow us to maintain a sort of engagement with these founders that allow them to tap into follow-on capital without necessarily having to, at the same time, give away too much on their bargaining end of things. Now, what have we done so far? As an accelerator, we've invested in 17 startups so far. We launched the program. It is a young program. We launched it in 2023, and we've then invested in 17 startups with a couple of others in our pipeline. So this number is due to grow by the end of 2026 to the mid-20s. And just to speak to some of these startups, we have 55% of the portfolio in agriculture, 22% in financial services, 11% in technology services, and 11% as well in transport and mobility. These are the brands that we are building, and we know that these are the brands that will be the big brands of tomorrow. Now, to today's conversation. How are we positioning ourselves as the Jasiri Growth Accelerator? But first, we would like to understand what does the accelerator landscape actually look like. The support landscape for founders, as you know, is sort of a spectrum. So we have, at the beginning, you have incubators, then you have accelerators, and somewhere in between, you have what we call venture studios. So we want to just look at these three concepts of how entrepreneurs receive support, what really works, and potentially looking at how Jasiri stands out against these. Now, these three models are basically three different bets. When a founder walks into an incubator, they're basically looking for their very first hand-holding, their very first support to be able to create this business, create this idea into something that is commercially viable. So it is typically at the idea to early prototype stage. Usually you find the durations are quite short, most cases open-ended. You can continue to receive advisory services, mentorship, coaching, etc. from incubators. Capital at this stage is very limited, typically is grants. So you find that your first check is a grant that the incubator may have connected you to, potentially a DFI, or they themselves have raised some funding and are able to deploy grant funding to the best opportunities that are within the incubator. And most ventures within this category are basically trying to find their footing. What do I mean by this? They're looking for product market fit. They're continuing to understand who their customer is. They're continuing to understand how the market and the environment that they're in operates. They're continuing to understand who their competition is and basically find a positioning that they can take advantage of commercially. Now, looking how to sum it all in one word, this is basically your mentor. This is the person who you reach out to basically soundboard if this is something worth pursuing or not. And on the incubator stage, there are a lot of, so the mentorship is one-to-many. And the disadvantage of this is you get generic information, generic feedback, and which typically means that you're not able to narrow down as a founder what is the way you should follow, what is the path that actually leads you to the next stage of growth. Now, accelerators come on board when you've been able to do some groundwork. So once you graduate from an incubator, you actually go into the market and you're able to start to gain traction. You typically come on board to an accelerator to be able to take that to the next level. As the word actually just means you're accelerating something in motion. So it means you already have some traction, but you're looking to take this to a scale level. Typical accelerators are very short term, so 3 to 6 months. And what this means is for you to be able to take advantage of the accelerator, you already have to have done majority of the groundwork. Now, this is not what typically happens in practice. As we do know, founders join accelerators with very high expectations. However, because of the gap and the disparity and lack of understanding between where the accelerator wants you to be, the support they provide versus what you've been able to achieve, this leads to some, I would say, friction elements. And this time period typically goes by quite fast, and you find that you're not able to potentially meet your growth milestones, you're not able to tap into opportunities that the accelerator had presented to you upon joining. And in that sense, it almost takes you to a position of abyss, in the sense that ventures that go through accelerators always look at it as a path to follow-on funds. And when there is that misalignment and accelerated timeline, you typically have a high failure rate of ventures that are able to secure the resources, the partnerships that they need to build. And this is one model that we looked at and considered differently. We looked and said that 3 to 6 months is typically too short a time to be able to do this. A full business calendar year, even when you're filing your financial returns, is 12 months. For you to be able to understand the seasonality of business, 3 to 6 months is typically too short for you to see what to focus on. So for us, we looked at it as a 12-month period where there's direct support, and then there's a continuation we call post-program, where it is light touch, where we continue to engage with our portfolio companies. Now, similar to other accelerators, such as ourselves, we do provide a seed check. For us, it's $75,000. Equity taken typically in accelerators is about 5 to 7%. And this is best for scaling and getting funding thereafter. Now, one thing you need to consider before you join an accelerator is they look at it as a coaching element. So you need to understand your business. You need to understand where the gaps are if you're looking at generic accelerator support. However, if you're looking at models where there is a bit more tailoring, there is a bit more hand-holding, then this is a more ideal situation for you to partner with, accelerators such as Jasiri, as an example. Then we have the go-in-between. The venture studio. This is a recent concept that has sort of tried to address the challenges between what incubators do achieve as well as accelerators. And this is more of a co-founder model. Now, venture studios are typically the most difficult to be able to get that type of support just because of the demand and also the ability to absorb startups. They often look at the founder and they invest in the founder or the founding team, and they try and build a vision together, and they take the role of co-founder. From this, venture studios typically go the 24 to 36-month route. What they do offer is capital and what we call a fractional support team. So you're able to tap into professionals providing fractional support. So for instance, if you need some financial management within your organization, there is potentially a fractional CFO, a potential fractional CMO who can support with marketing, etc. Now, the trade-off for all of these support is, in terms of equity taken, is the highest. You're looking at trading as much as little, I would say not as little, but truly 20 to 80% is quite significant if you're building a business. They do this because they're able to trade against the support that they're providing you. They're walking this journey with you. And what happens is, in most cases, venture studios do support, on the minimum you find maybe 3 to 5 teams per cohort. Now, why is this restrictive? Is because you as the founders, of course, in the ability to tap into a venture studio, you've traded away a significant portion of your own shareholding within this business. Secondly, venture studios operate from a sustainability perspective. They want to build a business to a position where future investments that come in, they are the first to cash out. So what happens is they would then put in potential clauses within the agreements that they put with yourselves to be able to tap into opportunities where future investments allow them the benefit of cashing out first. Now this, again, is a model that's very interesting. Again, when you look at how practical it is for everyday founders who are looking to maintain and grow their vision, and I just want to draw back again to our organization. If you want to walk a 50-year journey, how do you be able to look at partners who can help you get there? Because the true value of what you will be generating, you will tap into, future generations will tap into. So picking the right partner as you build at this early stage is quite critical. Now, I just want to give some snapshot details about our African context and the reality on the ground. You find across the continent, we have about 55 countries, sorry for that, but we have 514 hubs, incubators focused, and you find that themselves are also struggling to build and maintain their own sustainability. Now, 30% typically are profitable. The bulk of them rely on grants, as we do know, and the grants also have strings attached. So you find that incubators are only able to provide services for as long as they are also able to tap into funding. High-level statistics, you find that 280,000 entrepreneurs have been supported through support organizations, and these support organizations include Jasiri as one, but across the continent there's 1,200 of them. Now, the interesting concept I was mentioning around venture studios, there are only 50, roughly around 50 across the continent, and the reason is because a lot of people are still not yet buying into the idea of building with a whole institutional co-founder, which is something that a lot of investors are also still trying to understand the concept of what does that mean, having an institutional co-founder build a business that potentially they would exit as soon as follow-on funding does come through. Now, there is, on the bright side and the good news, there is more support than there has been in the past. Most of it, unfortunately, can't fund itself. And founders are definitely always trying to bounce in between. So you have what we call program entrepreneurs. You have a founder who's able to jump from one incubator to the next, an accelerator to the next, as they continue to source for the right partnerships and the right resources to take them to the next level. Speaking to what some of the disadvantages of generic support is, and particularly on the accelerator side of things, the market is voting with its feet. What do I mean by this? General accelerators or ventures that have gone through general accelerators have generally received less funding. You are finding that most startups are able to raise funding even without going through accelerators. And this is due to network effects. This is a very interesting concept I will speak to in a few slides. There is training fatigue and investor distrust. Definitely investors in the room have come across founders that have been jumping program to program, but they're not able to actually ascertain what true value did they get from that program. Not only that, how did this translate to actual traction and growth of the business? Founders do cycle through different cohorts, chasing grants, chasing smaller checks to be able to keep their operations going. However, they end up trading quite a lot more than they anticipated, and in doing so, they continue to not meet the investment readiness elements. Secondly, you come to the biggest elephant in the room when it comes to early stage support. Cash is not the active ingredient that is embedded in early stage support. Unfortunately, when you look at incubators, look at some accelerators, they're not able to provide founders the meaningful capital that they require at this stage to build. The evidence does show that as much as there are some grant opportunities, it isn't sustainable because most founders find themselves in interesting positions where for you to chase the next grant, you have to mold or pivot your business to suit the proposal or suit the need of the grant giver. And in that case, you find yourself chasing grants within, but not making much progress when it comes to your actual business. Then last but not least, when it comes to investment readiness, a lot of accelerators have sort of this one-size-fits-all model, which focuses on a checkbox system. So looking at creating your pitch deck to make it attractive for investors, looking at, or rather building support for cohorts or ventures that are sort of mismatched. You find yourself as an early stage company. Early stage is a generic term. If you're a business building in the mobility space 3 years in, you have definitely different needs to a business that is a fintech that has been building for the last 2 months. And looking at that, if you're going to get the same type of coaching, the same type of mentorship and sort of training material, you find that for one, it might not be as useful to the other. Secondly, we have a misleading sort of mentality when it comes to accelerators, that over the course of 3 to 6 months or even a year, this venture is suddenly going to have achieved certain things, and beyond that, they're going to be in a position to attract investment partnership through what we call demo days. I like to think of demo days as an opportunity to get feedback rather than to chase for anything else, because at that particular point in time, what you're doing is presenting your venture in a position to different stakeholders who can be able to share different experiences, different feedback that would be more important to you than you're trying to do in press in terms of receive follow-on capital. It's very unlikely that I've not come across a day where there's been a venture demo day and there's been a check written within the same day. And I'm happy to hear anybody who's had an experience where you've gone for a demo day and that evening you receive a bank notification or at least a confirmation of incoming funds. Right. Now, how does Jasiri bridge the gap? What we focus on is venture building support. So this looks at dedicating a team of expert venture builders who actually understand your business inside out, not because for any other reason, but they are actual experts within this particular space. So if you're building in the mobility space, we look for a venture builder who has the expertise to understand how does the mobility industry actually operate, right? What are the key drivers, levers that need to be pulled to be able to take this business to the next level, as well as what are the pitfalls that other ventures operating in this space are navigating or have gone through. If you look at what we also do, we build for sustainability. And the narrative I gave about Allan Gill Gray Philanthropies was the reason we have a SAFE as an instrument is because we understand that, and to note, the SAFE has a minority stakehold when it does convert, and to note that we are looking to support the founders build to the next level. We're not looking to profit cycle in, cycle out, and then sort of move on to the next cohort. What we're trying to do is basically create a launchpad using this instrument for founders to be able to, one, create validation in the market, and through this validation, able to create a narrative that they can take to the capital providers that is built on sustainability, built on growth, and built on not assumptions, but actual traction data. And the most important within the whole model is network effects. This is something I've been alluding to. But beyond introduction to investors, what we try to do is actually bring investors day one. So as a cohort, you join the program, and the support you receive is also informed and influenced by what investors are keen to see. By that I mean you're not trying to fit their shoes, but you're trying to understand from an investor perspective, what does bankability look like, right? What do investors actually envision from your opportunity as a deal? Right, and from that mindset, you're able to work hand in hand with these investors, as well as other stakeholders, to continue to build for something that creates value, something that, at the end of it all, you're not pitching as an introduction, you're actually showcasing the traction you've made over a period of time. So this is also an opportunity. How we do it is creating warm access. It's not just a directory of investor connections. So this warm access is through different engagements. So investors, stakeholders are always in the room with you as you continue to build. You're also creating what we call founder discipline. One thing you realize that investors do struggle with, and they can also speak, I'd love to hear their thoughts, is the constant, the ability to have insights into the deals that they've invested in, the ability to actually get validated traction, evidence, or growth of the business on a periodical basis that is predictable. Now, us as investors, we try and build this within our founders so that they have this discipline to maintain that reporting, that level of diligence when it comes to their investor engagement. And not only with the investors, but with other strategic partners. Why? Why is this important? Because business is based on trust. The ability for me to continue to work with you, for me to support you, for me to open doors for you is your ability to hold your end of the bargain and maintain the trust we've built. So that is why we believe network effects is quite critical to what we do. Now, just to reiterate the point, it's real support to the real readiness. So accelerator support for us does not mean a checkbox event. It actually means helping the founder understand what is it they want to achieve, what growth milestones make sense for them to be able to drive towards, how do they do this from a resources perspective, who is it they actually need to connect with to be able to unlock this. And we do this through building a development plan. And this development plan, we do have quarterly reviews, but practically what we do is we're looking to keep everything the founders are working on relevant to the growth of the business. Investment readiness still ticks the traditional elements, so you will get your standard financial model that showcases where the business is at right now, vis-a-vis where it needs to be, what the assumptions are when it comes to your growth, what are you actually looking to achieve over the course of 5 years, and even beyond, looking at a 10-year frame and saying, should the markets change, where will your business be? Because we're not building businesses for the next presidential cycle, as I like to say it. We're building businesses that will create meaningful change for generations. Now, an interesting concept I'd like to introduce to you if you're not familiar with. There's an old saying that says you're 6 handshakes away from anybody in the world. Did you know that? Right? You're literally 6 handshakes away from anybody in the world. What that means is, if you meet me and I've met 4 people who could be meaningful to you, I could essentially connect you to those people. So your ability to create the right networks is very important from a business perspective. We all know this from a social perspective. Now, sorry. Beyond that, looking at it, it's not just about cold connections. It's actually about creating chains and links that can be warm and tapped into when needed. So you need to be in the right room to be able to tap into the right degree of connection. And what we try to do is be able to maintain or create warmer connections for our founders through whatever particular element they're looking to focus on. So when it comes to fundraising, one obvious element is how do we connect to founders? How do you connect founders to investors? So we play the intermediate role to seek investors who have investment thesis that align to the business, the vision the business is trying to build, or even the area of operation. And we try to create those connections and maintain them warmly. Now, beyond that, this also does not apply just to founders and investors. It also applies to other key stakeholders. We do know businesses do not operate in isolation. You work with regulators, you work with upstream and downstream partners. How do you create more meaningful, stronger partnerships with these particular stakeholders to be able to grow your business? And this is one thing that we focus on quite strongly. So the network you have is basically your ability to tap into your net worth. Now, what does good look like, right? What does the evidence suggest good looks like? Typically, you find accelerators focus on selective intake, real traction, capacity building, substantive investment readiness, deep support, founders that keep their ownership, and more importantly, a real and warm network. Now, for us, we always look at businesses that have product market fit with real revenue and real growth. We embed, like I've mentioned, venture support, and the rest of the offering focuses on creating a founder-friendly environment that enables the founders to be able to take most advantage of the resources available. Now, generic models, as I've just tried to look at, is they always have a broad intake. They have some mismatching when it comes to mixed stages. You find that, as I mentioned, early-stage founders operating have their different stages in their journey, yet are receiving the same sort of generic support. They are curriculum-based. They focus on demo days and showcases as an opportunity to take to the world their ventures and their portfolio. And more importantly, if you look at what it means on building networks and building sustainable connections, you have generic intros and worse yet, weak follow-throughs when it comes to unlocking opportunity. Now, what we try to do as the Jasiri Growth Accelerator is not just set aside a way of doing things, but we try to actually create a standard that we believe should be embodied by all the accelerators or players within the entrepreneurship support side of things. Now, from this standard, it's worthwhile when it comes to saying you're truly supporting entrepreneurs to actually grow their businesses, and you're not creating vanity metrics or vanity narratives for your accelerator on its own. Now, I want to walk through 3 practical cases that we've actually supported within the portfolio. And basically what I'm trying to showcase to you is support to traction. The first case is a company based out of Rwanda. It's called AfriFarmers Market. And what they do is they connect smallholder farmers to buyers through an e-commerce platform, securing access to stable markets, fair prices, while offering agronomy and training services for sustainable farming practices. Now, AfriFarmers was one of the cohorts, was one of the inaugural cohort members when the program did start in 2023. And the support looked at basically, as you all know, an e-commerce platform is a solution that a lot of people look at, where basically you're creating a marketplace. So you can imagine how saturated the market is, where every agri-tech is looking to basically take farmer produce to market efficiently. Now, AfriFarmers, when they did join, we tried to basically say and uncover the next layer of this market, saying, who is the end customer and who is the main contributor? So in this case, the main contributor is the farmer. Most people look at saying, how can we increase efficiency through logistics? But how do you not improve the farmer's ability to, 1, improve the quality of their yield, increase their yield, be sustainable, be commercially viable for you to actually have a meaningful product to consistently take to market? Now, if you're relying on e-commerce platforms where they focus on the transaction side of things, you typically have disparity or gaps when it comes to sourcing for quality produce to take to market, and then you have the biggest challenge of customer dissatisfaction, which is stockouts, inability to be consistent. Now, for AfriFarmers, we looked at the model and said, how is it you can improve and create a community of smallholder farmers? And this smallholder farmers, thank you, this smallholder farmers community grew from 1 district, and I think they started with about 100 farmers, and currently they've grown this to 13,000. And why this is important is through their model of training and embedding farmers within their actual business and not looking at them as just suppliers, they were able to, 1, improve farmers' ability to create or rather produce the different agricultural products that they produce, 1, sustainably, 2, they were able to improve practices so that the seasonality challenges that do come with farming produce are then mitigated, and 3, because they're working directly with the farmers, cutting out the middlemen in this whole value chain, the farmers built the trust and continued to create that network effect that allowed AfriFarmers to be able to work with multiple cooperatives. Now, where has this brought them across the 3 years that they've been within the Jasiri Growth Accelerator community? When they did start, they were doing their early revenues of about 100,000. This is annually, and when they did close, over the 3-year period, they've been able to generate almost $4 million in revenue. And this is through understanding who the key contributor to your business is and actually solving a pain point for them. We did this through assessments, like I said, the venture building support, the network effects, bringing in the right agriculture sector experts to be able to help this particular company unlock this on the supplier side of things. Now, you may ask yourself, okay, John, that's the supplier side of things, but what about the buyer side of things? From this, they were able to build credibility, validation, and they were able to then position themselves when they come to customers and create that level of trust. And from doing so, they were able to build quite a strong network of B2B customers. And right now, they are one of the biggest suppliers of all of the biggest hotel chains that are within Kigali and operating within the broader Rwanda. And that has positioned them to be able to continue to build sustainably over the course of their growth. The second venture is a Kenyan-based venture, and it's called Moti. And what Moti does is they started off as an operating system they started off as a platform for car rental services. How many people have rented a car for an occasional trip within the room? How many people have gone through the trouble of or rather the process of trying to get the car, confirming that the person giving you the car is the same person, the payment is there, everything is above board, the car is insured, the car has no damages, you've marked everything, you've confirmed the scratches that it came with so that you're not held liable for those scratches, etc. That process is quite tedious, and this whole marketplace is literally functioning on a lot of mistrust. Now, when it comes to Moti, I want to speak to the venture building element of it all. So they were operating basically a platform for people such as you and myself to be able to access cars from renters. However, when we did an assessment of what is the biggest challenge within this, we realized that the problem is not a direct B2C lens, but it's more of a B2B lens. How do you actually empower companies, fleet leases, to be able to optimize their solutions, create more trust, and in doing so, create a marketplace that users such as yourselves and myself can be able to go onto and trust. Now, what they did through this process, they transformed their business and pivoted from a B2B model, a B2C model, directly to working with B2B2C, where they built a SaaS business management solution that basically integrated fleet operations, bookings, payments, analytics, predictive maintenance for the fleet managers. And also on the buyer side of things, the consumers, there was that ability for visibility on trust, a clear payment solution, a clear ability for you to trace your bookings, for you to see what does it mean, how many steps do I have to go to take before I can actually get the car. And in doing so, they built a trust-embedded model. Now, why Moti is an interesting case when they locked into this model is when they started in Q1 of 2025, they were doing roughly about, I actually recall their numbers, in Q1 they closed their revenue about 18,000. I just want to give the audience a guess. What do you think they actually closed when they did their annual for 2025? So that Q1 they did 18,000. What do you think they did for the last 3 quarters of the year? Any guesses? No answer can be wrong. 45, okay. Any guesses? 2 mil. I love the ambition of the investor. So they actually they closed the last 3 quarters having crossed 750,000. And when they did a Q1 25 to Q1 26, they had crossed about 1.3 million. So what they were able to unlock was, the only currency that investors truly look at, the dollar. So they went from $18,000 in Q1 to about 1.3 million in Q1 of 2026, which we recently just closed. Now, they were able to do this, but I'm not going to ascertain that it was fully Jasiri, right? The founders have been building their business, but they were open to exploring a model where they embedded the research that the venture builders they conducted and they were able to work together with. They were able to assess truly what is the pain point they were solving for. Originally, when they set up, they were solving for the pain point of the user who needs to rent a car. But there is a much bigger pain point when it comes to the B2B element, which is basically a fleet management, and it is through that fleet management that they're able to offer customers a much better experience. So I may not be able to, and when they started, maybe as take a step back, they were managing a very small fleet that they had to convince people who had vehicles to onboard on their platform, but they now shifted to operating for businesses. So we already have businesses that are in the rental space that have significant gaps, that don't have standard practices of operation, that don't have actual standards when it comes to customer service, customer engagement, traceability, payments, etc. And they were able to transition from a B2C side to a B2B2C side, where now they're able to onboard these fleet operators and create what is one seamless experience for the customer, having created a standard for all fleet operators. They're currently operating in Kenya. They recently are exploring expansion to the GCC region, and they're looking to also expand to our nearby countries. So this is Moti. And the final example I want to give is Padvention. Now, before I speak to Padvention's business value proposition, when you think of a company in a B value chain, What do you think is their main course of business? I hear selling of honey. What would be a secondary business chain or business model? Beeswax, that's a good guess. All right. Now, PatVenture, when they joined, they were looking at creating or enabling the bee value chain by production of beehives. So innovative beehives, which basically speaks to honey, right? Now, how much do you think a kilogram of honey is worth in the market? In dollars. Give us a guess. Yeah. If you had to pay for a kilogram of honey in dollars, how much would you pay? Say $5? All right. Now, when we assessed the opportunity for PatVenture, we realized that they were operating the bee value chain, but they were looking at the wrong type of product. How many people have heard of bee venom? I'm sure everybody's been stung by a bee, right? Now, bee venom is a very interesting product. Bee venom is one of the key inputs when it comes to cosmetics and pharmaceuticals. Now, when it comes to the bee venom industry, the same bees that produce honey produce venom. Now, what they did at the time, they were looking at creating a bee venom collecting device, which they patented. And in this case, as we all know, when a bee stings you, it does die. But in this case, the innovative technology they produced allows bees to be able to produce and extract venom without necessarily dying. So in this case, the bee is able to continue to live and produce and continuously produce honey and venom. Now, why I brought the idea of, or the concept of bee venom. 1 gram, not kilogram, of bee venom. How much do you think that is worth to the pharmaceutical or cosmetics industry as an input? Any guesses? $5? No. So I'll correct you. So they recently are working with a pharmaceutical manufacturer in the United States, and the manufacturer is paying $25 per gram. And there's 1,000 grams in a kilogram for bee venom. Now, they've been able to pivot their business to focus on this because this is a much larger market. This is a more sustainable market because when it comes to the consumption of honey and beeswax, that is a finite market and heavily saturated, as we all know. But when it comes to the inputs or the provision of bee venom into cosmetic products and other pharmaceutical products, there is quite an opportunity there. Now, what they've been able to do is grow their business model around this innovation, and beyond that, sustainably, they still continue, of course, with the beehives manufacturing. Now, this is a win-win to farmers because what they essentially did was enable a smallholder farmer in central Kenya to tap into a market he or she did not actually know existed. The value return on the same bees is almost, if I did the math, you said $5 for a kilogram, and that is now $25,000 for a kilogram of venom. So that is basically a 5,000, sorry, a 5,000 times return. Now, this is why venture building with experts is very important when it means looking at support. You may come into an accelerator having already understood a particular market, but we then ask the true questions of what is it you're truly trying to solve for? From the products and solutions you have, are you really addressing the needs of potential stakeholders or consumers who exist in the market? Just leveraging what you have, right? We're not trying to reinvent the wheel. We're not trying to take you away from your vision, but we're trying to get you to see truly what is the bigger picture or what is the true value you can capture from your business. Now, what is it we're aiming to achieve? And I like this part of the presentation because it usually brings a little wow factor. Now, the scale of the ambition behind the Jasiri model is basically to build what we call an African lion. I'm sure everybody here is familiar with the concept of a unicorn. What is a unicorn in the startup world? Any guesses? Or somebody to just remind us? Yes. So a unicorn is a company that's valued at $1 billion. Now, why we choose African Lion, we like to contextualize it, and what we deem as an African Lion is a company that's worth $100 million. Now, I'm going to just take us back. There is a gentleman called Carl Schramm, and what he says is, when it comes to the concept of unicorns, is the single most important contributor to a nation's economic growth is the number of startups that can grow to $1 billion in revenue within 20 years. Now, on the African continent, this is a global, of course, context, but on the African continent, this is quite hard to do. But we understand $100 million companies are achievable, and that's why we conceptualized the idea behind African Lions. And why do you think African Lions are important? So just reiterate, an African Lion is a company worth $100 million. There is a multiplier effect. Now, we say that for us, when we understand from what he's done in terms of his research working with startups, he says that most startups create value, but internally they're only able to tap into a very small portion of that value. Society truly benefits from that value. Hypothetically, if a startup generates 5% of value, worth of value, and it's worth 100 million, then the value it's given to society is basically 20x that figure, which is worth 2 billion. Now that 2 billion is not dollar terms or in terms of cash, but it's through various ways. The first is going to be jobs which create wages. The second is definitely tax revenue. The third is transferable innovation and skills to the economy. The third is supplier income, because the startup does operate along a value chain. The third is customer value and productivity, especially if your product or service inputs on the customer side of things. And the fourth is definitely community and societal value in terms of public services. When you have a mobility startup, for example, Uber coming to Kenya, it has enabled ease of access of travel, right? We have our famous homegrown startup, which I don't think is a startup, but we have M-Pesa. How many times, I'm sure everybody today has probably engaged with an M-Pesa transaction in one way or another, right? And that has enabled the transfer of funds, financial services, to businesses, to individuals, and in doing so, Safaricom has drawn a small portion of that value through the transaction cost. But to you, the user or the beneficiary, whether on the customer or on the business side of things, you've been able to tap into larger value than Safaricom truly has, right? Now, one African Lion, but multiple ripple effects, and that is how an economy is transferred. So we, as the Allan Gill Gray Philanthropies, have an ambition to build 25 African Lions by 2030. Our sister entities in South Africa have successfully achieved 6. So we are meaningfully on our way there. We're 25%. So we're hoping to accelerate that growth over the next couple of years. Now, this is basically why we believe that supporting startups in a meaningful and very intentional way can be able to help transform society. One, we will benefit, of course, as early stage investors. The startups and the founders will benefit from gains and growth in wealth. However, what we're trying to achieve is ultimate generational societal value that will outlive the founders, the ventures, and even the program. So what we're trying to do is build one African Lion every year, continuously even beyond the 2030, and not by chance, but by the same discipline that the model was originally built on by day one, working to build long-term value. This is what the future that Jasiri is building, and we invite you to be a part of it. Now, as a program, this is an opportunity for me to share that we are launching a call for our next cohort of ventures within this coming month. I will be happy to share with all of you. I do note you've registered, so your contact details are with us. I will share with you details about the program, details about the cohort intake, and details in terms of timelines and expectations. And from this, I hope that you can engage. Feel free to share this within your networks once you do receive this information. As part of that, I will also share this presentation, and in terms of if you'd like to connect after this, I'm very much available to share this. And thank you so much. I know the rain has come, so thank you so much for listening to me. Happy to take any questions and be a part of the future you want to see. Thank you.
All right, so as we take on the questions, I think I have the first one, and then we will do this as usual, systematically, from the front to the back, until all questions are answered. But don't worry, John, the rain has come. I think the African context is when it rains, it's a good thing.
I agree.
So this has been a blessing. Principally, my question would be, as an accelerator, a lot of people show up and they go, I've got this thing coming, I've got this program, this innovation, whatever. But in the same vein, it's your responsibility to invest ethically, even for those who invest in you. So in the temperature of the times, there is this AI thing that has seeped into everything. Everyone wants to do AI. When do you, as an accelerator, evaluate the market and go, okay, this venture might be too risky? Or, as a whole, this trend is heading towards its bubble phase, and we might need to advise you to either rethink, readjust, or you might be the unicorn in the crowd of ideas within this sector that's coming up. Because I think at the moment there's AI everywhere, and you mentioned, I think 43 or 45% of the ventures that you are in are agri-based. So when do you sort of go, okay, based on what's happening, you might need to rethink?
Thank you, Arthur. That's a good question. A different way to look at it, yes, we understand we're in the AI wave, but a different way to look at it is, on the African continent, we have significant real problems that have not been addressed. And to a certain extent, AI has the ability to create efficiencies for software solutions or efficiencies within solutions, but it isn't the solution, right? We would look at a venture and assess what is the value proposition, what is it they're trying to build, and what problem are they actually trying to solve, right? AI is a wave, but if you look at a lot of African communities, a lot of context that is outside of the urban areas, there is challenges when it comes to basic needs. There is challenges when it comes to access to food. There is challenges when it comes to financial services, financial literacy. There is challenges when it comes to mobility. There is challenges when it comes to healthcare. Now, AI in itself can play a role in these solutions, but it is not the solution, right? There is still always going to be a human interface required when it comes to product delivery or service delivery. Now, we look for businesses that are creating meaningful value for communities and empowering them to take it to the next level from a commercial but sustainable perspective. The impact is part of this journey, but it isn't the only lens. And more importantly, to your question, yes, we will come across multiple AI startups. Variations of models that are curated or tailored to the African context. And one thing I've come to learn over the recent past is we still have majority of the continent not accessing the internet, as an example. So how would you then take advantage of an AI-based solution, right? If you look at M-Pesa, maybe not to belabor this as an example, but M-Pesa's biggest customers use feature phones. If you built an AI solution to reconcile even an M-Pesa statement, how are you going to share that to a feature phone, as an example, right? So, and I'm looking at it from the ability to have an app, et cetera, right? So I think it's a good question, but I think there's still significant problems that have not been addressed that, again, AI could play a position when it comes to efficiency creation, but I don't believe it will be the centric solution.
All right. Any questions here? There's one here. So I'm coming round section by section.
Thank you so much for the presentation. It's fantastic. Just there's a slide where you showed, primarily the 16 partners that you've worked with, and I see it's primarily agribusiness. So what's the scope that you're looking at, in terms of partnerships as well, and who you want to work with as an organization? Is it, yeah.
Yes, so these 17 are our actual portfolio companies. Now, it is skewed to agribusiness because, as we do understand within this region, agriculture plays a very significant consideration when it comes to our economic activities. So the program is sector agnostic, but these are the opportunities that are funneled through and had success when it comes to the selection. It isn't, I would say, a projection of where we're going as a program. Of course, these dynamics can shift. We can have an influx of financial services companies. We can have an influx of healthcare companies. What we were trying to do within the different periods of selection is these were the ones that emerged as the top opportunities to support through those venture cycles. So, like I said, this is indicative of just the portfolio, but it isn't directional to what we're trying to achieve as an organization. So it is sector agnostic. So there is that opportunity to, you might be operating in a sector that's not even listed, right, on this particular slide. So there's an opportunity if you are a founder to come and engage and indulge us with your venture.
Anyone here? Okay, so I will cross the room to the lady at the front, then Ronald with his lovely sweater.
Hi, so my question is, at what annual revenue or stage do you consider a business ready for the Accelerator program?
Thank you, that's a good question. So there isn't a fixed figure. And the reason I say that is because, remember, it's sector agnostic, right? So you might have if I look at a financial services company versus an agri-tech, it'd be quite unfair for me to say I need you to be generating, for example, 50,000 annual, right? Because the fintech is probably likely to turn that around much faster than an agri-tech business is. So it is a case-to-case solution. Of course, there is a floor. So the floor would be typically 30,000. Right? That at least ensures that you've been able to generate meaningful revenue over the last 12 months. And we're able to assess the seasonality of your business, because as part of your submissions, you're not just sharing that, your financial records that I generated 30,000, but we're actually looking at it month to month to understand what are the dynamics. So we understand in a calendar year, different things affect different businesses at different times. So we're trying to understand, were you able to maintain a certain level of it over the last 12 months? But for businesses, of course, the threshold to join the accelerator means you have to have operated for at least 2 years. So we're able to then trace back and see over the previous 2 years, how did you actually perform, right? And this financial information, of course, has to be audited to be able to be verifiable. So then we're able to assess these businesses and say, this is the opportunity. So this business has consistently grown, potentially from 10,000, 20,000, 30,000, and now we're seeing that they're actually on a path to growth. However, again, to caveat, it's sector agnostic. So this is not applicable because, again, the accelerator is looking at businesses that have the best opportunity presented. So you might find a fintech coming on board generating 90,000, having grown over the same period of time. And that is how the business is presented. The context to the IC, again, the investment committee is also provided, that within this sector, this is understood as the research literature of growth. And within this particular sector, it's slightly different. So with this, we expect businesses to be at this level.
My question is, what pattern, if any, do you see in startups that get funding versus those that don't get funding, even though they both look good on paper?
Thank you for that. That's a good question. Now, when it comes to getting funding, it's basically built on trust. And how do you showcase trust? You showcase trust by having processes and systems in your business. So you don't necessarily have to be the fastest growing startup, but you have to be the startup that is verifiable. If you tell me you've made $1, I'm able to actually trace that dollar. Compared to the person who comes and tells me I've made $1 million, it looks very shiny, it looks attractive, but I'm not able to actually ascertain that figure. If you tell me a margin, if you tell me, for instance, you're in a market, and I like to use this joke, we do market sizing, not top down, but literally bottom up. Because everybody comes with a market sizing slide saying, there's 1 billion Africans. In East Africa, there's 250 million Africans, and in Kenya, there's 50 million. So if I can get 10% of the Kenyan market, I'm going to bring this return for my investors. So you're basically trying to get me to believe you will tap into 5 million Kenyans. Do you have a path to that? So we look at it from the reverse. How many customers do you have? How many of those customers are repeat businesses, not one-off trying, but actual people who came back because the value you provided the first time round was worth, and it solved the problem they have, and that's why they came back. And then more importantly, how internally do you actually, how do you operate? How do you build the business? So are you constantly chasing customers with no systems, no verification, no traceability? How are you actually managing the team? How do you maintain processes, right? And that, to us, is a more attractive business because we can help that business grow and scale because it has the right foundation, right? So that is how we see businesses succeeding when it comes to the fundraising front. Of course, this is contextual to our continent. There are, other opportunities where startups and investors engage, and it's based on, the vision of the founder and the ability to create that trust. But again, it's still based on trust, right?
So I'd like to ask about what would you say are the biggest reasons that when it comes to venture capital that you guys choose to not go with a certain business as compared to another?
Thank you for that. We actually look at businesses individually. So when it comes to deals, we don't have an obligation necessarily to say we need to pick 5. So we compare one versus the other. We actually look at the merits and demerits of each business individually. So again, to add to the question that was asked earlier, your ability to showcase trust, your ability to showcase verifiable documentation, paper trails, etc., your ability to showcase evidence that what you're truly claiming on your pitch deck is real, right? And not just in terms of, for instance, the market sizing or the team, but actually saying, something as simple as, I know it might be nuanced, but somebody says, I have a co-founding team of 3. And this is person A, B, and C, and this is their skill set, etc. And I just go to person C's LinkedIn, and they have a full-time job, right? And that person is, if I look at just their profile, just as an example, they're actually engaging quite deeply in those activities. And here you are trying to convince me that this person is driving or is part of the team driving the business, right? I'm not saying that you must have a shiny LinkedIn profile, but I'm saying you need to have symmetry of information, right? When it comes to what you showcase, what you present, you must have information that actually aligns across different facets, right? So to the question you raised about what makes us pick deals, it's back to it being on an individual nature. Is this a good opportunity as it is? So we're not actually comparing you, and that's the element why it's sector agnostic. Because if we were in one sector, then we would actually be having, apples to apples and saying that this business is growing faster than this business, so we should consider this business A.
As Jasiri is in the middle of the investors and the founders and businesses, what have you, what in your Southern, Central, and Eastern Africa, what are the sectors to invest in now? And what are the sectors to, expend a lot of energy now? Because there's 2 classes of people here. There's the investors and the business founders. So if you were to sort of wake up tomorrow and you have some loose change, or you inherit some money, where should you actually sit down and go, yeah, I think I need to go into that? Or if you, don't want to actually get into an office, but you want to throw money at someone, where would you sort of sit down and go, this is a bet I'd put my money in?
Thank you, Arthur. I think I'll take a different approach. I will not look at it from a sector perspective. You can build a business in any sector, quite frankly. If you're solving a real problem, you will build a real business. If you identify a real problem, you put in the necessary resources to understanding the problem, doing the actual groundwork, and trying to build a solution that addresses that problem, you're likely to turn out with a real business. And that is the business I'd look at. So I would not particularly look and say, okay, we're swaying to finance, or we're swaying to AI, or we're swaying to healthcare, because we're not really investing from a cyclic perspective. We're not investing because opportunities present themselves. We're looking at what is the value the business that you've presented can create. Every business, or rather every sector, has potential solutions that can actually transform that sector, right? And that is the value we would like to tap into. So I wouldn't give any indication that we are seeing, yes, we are seeing. In our region, like I say, we have agriculture, mobility, all of this. And we already have, in each of these businesses, rarely will you find you're the only player. It's very unlikely you will come and you're the first mover with no one else in this space. What you will be addressing, what you will have provided is probably an innovative solution to a problem that has existed or exists, right? Meaning there are other solutions or substitutes that exist, right? So in that sense of thinking, it's more about, are you solving a real problem? Do you understand the problem? Do you understand, the pain points of your customer or your consumers? And more importantly, how are you building the solution sustainably? Is there evidence that this solution has been adopted by your target customers? And this is always evidenced by repeat business. You use M-Pesa for a reason, use it multiple times for a reason. They are substitutes, right? But there's something it does solve for you.
The reason I'm asking that is, I think, and this is a context for all Kenyans, anytime a business sort of begins to pick up, we have a very monkey see, monkey do attitude. And then we rush into the right rooms. So again, with realizing that, and I'm sure it's not peculiar to Kenya, despite the fact that we like thinking that we're very unique. What would be the thing that, okay, I get in and I think it's agriculture, because again, I think 60-70% of business in Kenya is agriculture based. Like for the guys doing the bee venom, how would you advise someone to sort of go, okay, I'm in Kirinyaga, it's potatoes. What different thing do I do? How do you sort of sit down and tell someone, yeah, you've got the money, you've got the idea, you've got the brains, you've got the founders, you'll probably walk into a room and get the money, but how do you tell someone, okay, think about this differently? So that when I walk into a room with, there's an investor, someone there, and then I meet him, so I get him to give me money.
Again, I guess entrepreneurship in itself, I'd say, is individualistic. Everybody has a unique journey, everybody has a unique way of doing things, and no two companies are alike. You may be addressing the same problem, but your solutions are probably not alike. Your solutions could even be alike, but your model of execution may not be alike because the teams cannot be the same. Your ability to take your product to market cannot be the same. So when it comes to, maybe for the founders in the room, what you need to maybe understand to position, an idea or a business is, if you're truly solving a problem with your solution and you're able to create what I call stickiness, you will then be able to scale that. The moment you unlock the person who came back for the second time, you then say, let me understand this profile deeper. How many of this type of person exist? Then you start to address like on a scale level. But if you look at it from a quote, to use your words, monkey see, monkey do model, you will not have the ability to understand the intricacies as compared to this other path. Because you're basically assuming, if I see Arthur starting a fancy AI startup and he has 50,000, I may have 50,000. I can be able to do that maybe faster than him, take it to market and maybe make it shiny. But in essence, I've not understood truly what is the market knowledge that Arthur has. What are his insights based on? What assumptions is he making, right? Also, remember, from a network's perspective, I also don't know what network effects are in favor of Arthur. Right? So if I'm quick to jump to creating a startup because, it's something that is in season, then I'm basically putting myself on the back foot, right? Because Arthur could walk to the investor and raise funding because they have an existing relationship. I may not have visibility into that. So my advice would be, go to the world. The world has a lot of problems. Identify a problem you're passionate about, you resonate with, you understand. Identify who's actually going through this problem, right? What is it they're looking in terms of, like, how would they even presume it should be solved? And get those insights to build your solution. And then once you succeed in creating value for them and repeatable value, then look at that profile and build off of that profile, because I believe, I probably am right in saying, that person is not unique in a continent of 1 billion people.
So this is just a follow-up of the question, of the explanation you've just done in regards to preparing yourself as a founder for things. So I'd ask is, what is the perfect, or what's the best time as a founder to start creating relationships with venture capitalists or investors, even when they're not actively looking for funding or capital?
That's a good question. What I say is, don't create the relationship because you have a need. Create the relationship because you will need the relationship eventually, down the line. So I wouldn't create a relationship with the investor because I'm raising funding today. But I will create the relationship knowing down the line I will raise funding. So I'd rather build that engagement much earlier on, get them to understand, share insights potentially. Not everybody may be able to give you feedback, but you have the ability to create connections. If you do it early on, you have the benefit of them potentially even directing you along your journey to people who are more strategically aligned to what you need. Because one thing we see is founders build in silos and then come to the capital markets. And then there's this asymmetry of information saying, okay, we've been building this, but we've achieved this, and now we need all this money to be able to take it to the next level. But the investors are not understanding truly, how does this actually work for me as an investor? What is it? We're misaligned in terms of expectations on both sides, right? So one way to navigate that is build the relationships any opportunity you get, not because you need to take advantage of it at that particular moment in time, but because you know it could create that value for you down the line.
Hello. Thank you, John, for the presentation, and especially thank you for the job you are doing. I think it's really amazing direction and amazing mission for the Africa. My name is Alex. I'm building IT companies around the world for the last 20 years, so have some experience, and it's amazing to see what here in Africa is performing. So my question is about your failures, because learning from success has very strict limits, because on each successful startup you can maybe name 20, 30, 100 different guys who did the same with the same budget at the same market with the same time and so on. And it's very hard to understand why they failures, but these were successful. So for me, the most important experiences from failures. So my question for you is, what is your biggest failure during 1 or 2 years on the African markets? So you see some company, see some direction, see some area, and you maybe 90% sure of success, but of some reasons you understand that it will not work. And what's the biggest outcome from it? What the biggest lesson you take during maybe 1 or 2 years because of your failure? Thank you so much. Yeah, thanks.
Thank you so much, Alex. That is a fantastic question. So in terms of the learnings we've gotten within the Accelerator over the last 2 to 3 years, one of the biggest learnings is understanding founder dynamics. So one thing that does not come on paper is the ability for founders, so co-founding teams, to be able to collaborate effectively and work and manage themselves effectively. Now, this is something that does not actually come out, in the early days. So when you present your business to an accelerator, of course, you've put everything in line. You have your audited accounts, you have all your customers, etc. But one thing that does not come through on the application pack is basically the relationships you have with one another as co-founders. Now, what happens when the business starts to scale is when you start to see how this translates the business or confirms any assumptions you may have had, or any I would say gaps you may have potentially overlooked. So when it comes to the early days, of course, the idea was that, these are co-founding teams. They're working to building one vision. This is their dream that they want to turn alive for the customers and for the African continent. But as different levels of growth are achieved, or not necessarily even growth, sometimes it's backward steps. So for example, you're pursuing a license from a regulator. The regulator tells you it's going to take 12 months. Somebody then looks and says, I could get a job elsewhere. And then you start to see the founder dynamics. And through that is when you start to see the challenges where truly what was positioned as a very well-oiled machine starts to fall apart. And the learnings that we've had is to just be able to have sufficiently frequent interactions with the founding team. So knowing that businesses and businesses are built by co-founders, number one. But number two, these co-founders are human beings. Right? So having that human-to-human interaction on a periodical basis that we're able to ascertain truly where's the business going, how is this affecting relationships, how is this affecting everybody, what is the mindset of different founders within the team, how is that affecting potentially to the management team, what type of energy are they bringing, what type of culture have they brought to the team, and how are they maintaining that. It's very important for us. So we learned that without necessarily getting too much into the operations and the business, we would like to have just those insights from all the founders. When it comes to engagements with the program, we encourage, the full team to engage, because these are some of the ways. We also conduct periodical visits where we go to sites of operation, and these are things you pick up from a human perspective, when things are going well, when things are not going well, and how people actually manage different experiences. So the biggest learning has been, how do we then, when we're taking on founders or taking on new ventures, assess the opportunity. So of course, this is not something that is written, in black and white, that this will be an excellent founding team. But based on how we're able to do during various selection stages, we're able to make this ascertainities in terms of when it comes to one stage, you're looking at the business. When it comes to the other stage, you're trying to look at what was the vision of the business. So in one selection engagement, of course, you're presenting, you're pitching, you're presenting your information. That is all factual stuff. But when it comes to understanding what the vision was, how it started, where it's going, we give everybody an opportunity. And from that, we're able to constantly assess. Are they all working together? Is this something that needs to be addressed? And we also create support mechanisms. So we do understand business has different seasons. There are times where things can be tough. So we look to create support mechanisms where founders can actually come and voice some of their concerns, some of their challenges, and in a way that we as the program team, or the intermediary in this case, can be able to play arbitrator in that sense, or find other people who are better suited to help address some of these challenges.
Okay, so I think I'll ask the last question as we close, as the weather continues to weather. There is a lot happening across the African continent, especially in some of the countries where your Jasiri and your sister initiatives are. How does that affect the capacity to make the one African lion per year? Because I think you said your target is 25 by 2030, and we're 3.5 years short. You mentioned 6 in South Africa by the South African entity. So currently, I know we're in Kenya. There's a lot happening right now. A lot of us are sort of sitting there thinking, okay, it'll be a slow year as of August this year. So how does that affect? Rwanda has just, I think, finished an election cycle fairly recently. Uganda as well. Tanzania is restructuring even on a South Africa currently is going through something. Zimbabwe is settling from something as well. So how does that affect the capability, the capacity, and the projection for that target? Because 2030 isn't far away.
Yes, thank you, Arthur. Now, to start, as an organization, you have to be ambitious, so you have to set a goal. And you have to set a stretched goal that you want to achieve. That is the way to be able to make sure that you're effective and efficient with the resources that you deploy on a day-to-day basis, all working towards that goal. And secondly, we understand we, of course, operate in a macro environment. where there are certain factors that affect our operations or, our ability to achieve these goals that are not within our control. That does not take away from the effort that will be put in place to support these businesses. So should we not still meet the goal come 2030? It is, like I said, a long-term commitment to supporting entrepreneurs. 2030 is really not the end of the line. It is merely just a checkpoint in a continued journey. Then when it comes to how we support businesses managing the same macroeconomic environment, we help them when it comes to the research, when it comes to understanding how do you best position yourself. At what point in time maybe would you consider a strategic decision to downsize, or a strategic decision to pivot, or a strategic position where you're saying that over the next quarter I'd rather maintain my customers beyond going to chasing new business, or I would rather renegotiate potential engagements with strategic partners I have in the business to be able to help me continue to survive or weather that period. Context of Kenya, yes, you're correct that over the next month through the next 12 months, people are going to actually be holding capital quite close to themselves, and in terms of spending power, it's also going to reduce because people are not going to have as much willingness to let go of their disposable income, knowing very well uncertainties potentially could happen. So businesses are likely to be affected by reduced sales. Now, in that sense, we say that you're operating in this environment, so it should not catch you by shock. You should then plan, right? So in that sense, you look at the business and say, this is what we've achieved, so what is definitely feasible for maybe this period of time. For businesses where you're hit by a shock event, of course, we are all human. Nobody can predict what's going to happen in the next moment. But within reasonable judgment, you can be able to plan.
I think expounding a bit more, South Africa is a shock situation because no one really anticipated it would come this far, this soon, this quickly, with such resolve. So for someone who's got an enterprise that was just beginning to look nice, and I know typically the makeup of any enterprise in South Africa is you will have, yes, the South African locals employed, they will have Zambians, Botswanans, Zimbabweans, and Kenyans. That's generally the makeup. And it is a shock. I mean, people have been boarding buses and flights out of the country. So what would be, like, let's take a company X that does, let's place your honey people in South Africa. Suddenly, 3/4 of your people have to go for their safety. It's not you telling them go, they have to go for their safety. How do you begin to advise a restructuring? Because the bees have no nationality, they're bees, but the business must go on. And then I will close, I promise.
That's a good question, thank you. So in terms of what advice we would have is, number one, maybe I take a step back. The program and the support we provide is, so the idea behind, again, the investment instrument, they get $75,000, it is patient capital. So it has that capacity to continue to support. And in terms of the program, it's 12 months direct support, as I mentioned, but there is that continued community support, right? And this is where we're able to, because I would not say internally we have all the answers. Those are very difficult, questions you've posed. But we would then, look to our strategic partners we have and bring in the right kind of advisory that can help this business then plan. Of course, in such instances, you expect downsizing, you expect pausing of, operations and the like. But again, what we're trying to say is the businesses will benefit from the right kind of advice that the program would then seek to provide through experts, etc., so that then it can weather that storm. So ultimately, remember, even though a shock may occur, the problem the business was solving has not gone away. So it will continue to live, and that opportunity will be there. So I think when it comes to shock events, obviously the economy is stunned, everything pauses, likelihood of consumption, production, etc. halts. But what happens is through continued support, be it financial or non-financial, will position the businesses to be able to pick up should that pause. I mean, we all literally saw the world close in 2022, but there are businesses that were able to position themselves and continue. And that was primarily by getting the right kind of support that helped them enable or pivot or manage that process.
All right, I think we can give the man a hand. Thank you so much for making the time and presenting this beautiful presentation. But thanks so much for making the time. In case you have a question that you'd like personally to have to John, I think we still have you for a bit before we release you. The rain is now my hostage taker, so you're going nowhere for at least another 20 minutes. If you've seen a familiar face within the room, you can walk up to them and ask them, where have I seen you before? And if you don't have an answer to that, you tell them, you've seen me here, and then you exchange contacts. And then we see each other next month. But thanks so much for coming. And may you continue to connect, co-work, and create better opportunities. Thanks so much.